So you're a landlord, or maybe you're thinking about jumping in. It's an awesome way to build wealth for sure. But then tax time rolls around, and it can feel like a whole different ballgame. Well, in this explainer, we're going to pull back the curtain and make sense of the essential tax rules for anyone who owns a rental property.
You've done it. You got your first tenant, the rent checks are coming in, and everything's looking good. But then those questions start creeping in. How in the world do I report this to the IRS? And more importantly, what can I write off to lower my tax bill? That's exactly what we're going to tackle today. All right, let's dive right in. Think of this as your go-to guide for rental income taxes. We're going to break down the key forms you need, the most valuable deductions you can take, and a few special rules that you absolutely have to know about.
Okay, let's start with the basics. The secret to a stress-free tax season is actually pretty simple. Track everything. Every dollar that comes in, and especially every dollar that goes out. And why? Because a ton of those expenses are going to directly lower the amount of tax you have to pay. You're going to want to get familiar with this form right here, Schedule E. This is pretty much the official scorecard for your rental activities. All your income goes here, but just as important, this is where you list all those juicy deductible expenses. So, what kind of expenses are we talking about? This is where keeping good records really pays off. All the normal costs of owning a property are usually on the table. Things like your mortgage interest, property taxes, insurance, and, of course, any repairs. And here's a pro tip. Don't just track the big stuff. So many new landlords forget about all those little trips to the hardware store, but trust me, they add up and can save you a ton. And then we have the big one. Depreciation. This is kind of like a phantom deduction. It lets you write off the value of the building itself, not the land, just the building, over 27 and a half years. It's a massive tax benefit that you get to claim every year, even if you didn't actually spend a dime on it that year. All right, let's switch gears and talk about a really unique situation that a lot of homeowners can actually use. If you only rent out your place for a super short time, there's a special rule called the 15-day rule that can be an amazing tax perk. You ever think about renting out your place when a huge event comes to town? You know, like a big music festival or a major sports championship? Well, that short-term cash you make might just come with a very nice surprise from the IRS. The magic number you need to remember is 14. If you rent out your personal home for 14 days or less, total, for the entire year, a really special tax rule kicks in. And this is a big one, so listen up. Here's the deal. Plain and simple. Rent for 14 days or less, and that income is 100% tax-free. You don't even have to tell the IRS about it. Now, the trade-off is you can't deduct any of your rental expenses. The second you hit day 15, the rules flip. Now all that income is taxable, but you also get to start deducting your expenses. Okay, so we've talked about making money and even getting some tax-free money. But what happens if you go the other way? You know, what if your expenses, especially after you factor in that big depreciation deduction, are actually more than the rent you brought in? This is where things get a little trickier. So the IRS has this special category they call a passive activity. And by default, they just assume most rental properties fall into this bucket. This is a super important label because it comes with some very strict rules about how you can handle any losses. And here's the problem. If your rental property shows a loss on paper, you generally can't use that loss to lower the taxes you owe on your other income, like your salary from your 9-to-5 job. That loss gets stuck in what we call the passive bucket, and you can only use it to cancel out other passive income. For a lot of landlords, this is a major roadblock. But hang on, don't worry, there is a lifeline. The IRS created a really important exception to this rule, and it's specifically designed to help out smaller landlords who are more hands-on. It's often called the special loss allowance, and it's a game changer. So how do you get your hands on this exception? Well, there are two main conditions. First, you have to actively participate. Now, this doesn't mean you're the one fixing the leaky faucet, but it does mean you're making the big decisions, like picking tenants, setting the rent, and okaying major repairs. Second, you have to own at least 10% of the property. If you meet both of those conditions, you might just unlock this incredibly powerful benefit. We're talking about being able to deduct up to $25,000 in rental losses directly against your regular income, like your wages, and that can lead to some really serious tax savings. Now, as you might guess, there's a catch. This big deduction is really aimed at middle-income folks, so it's limited by your income, specifically your Modified Adjusted Gross Income, or MAGI.
If your MAG is $100,000 or less, you get the full $25,000 allowance. But after that, it starts to phase out and it disappears completely once your income hits $150,000.
And if you want a simple way to remember the math, here it is. For every $2 you make over that $100,000 line, you lose $1 of that potential deduction. So it's a 50% reduction rate, which means it can vanish pretty quickly as your income goes up. So at the end of the day, it all comes down to this one big question you got to ask yourself. How involved are you with your property? Are you a hands-off investor just collecting a check? Or are you an active manager calling the shots? The answer to that question is really the key that unlocks some of the biggest tax breaks a landlord can get.